Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
So for this quarter's podcast, I thought one of the things we could do, like we've done in past quarters, is go through and sort of highlight some of the key themes from the most recent quarterly report and have a conversation about some of those themes. And I think, as much as there's been focus on inflation this year, ups and downs in the stock market, what's going on with energy or Russia, Ukraine, I think really the biggest story that we would all agree on this year is how high interest rates have come and how fast they've risen to these levels. And so it's a scenario that we had talked about, in previous years that was always out there as a possibility, with record amount of years of very low interest rates at some level that at some point that was going to have to normalize. So maybe just speak to really the uniqueness of this year as it relates to interest rates rising and sort of the investing implications because of that rise in interest rates.
Yeah, and looking at it from a pure investment side. And so we would say from this time last year, we wanted to be defensively positioned. We were defensively positioned in bonds. We were potentially positioned in stocks. And this is really what was such an extraordinary year, is that we've had both bonds and stocks going down together at the same time. So, and putting this in context is normally for the last 40 year of history since the early 80s, when the stock market has had problems, basically there's been a flight to bonds, and bond market goes up in those cases. And why you have a balanced portfolio between stocks and bonds is that stocks will go down, bonds go up, or bad year in bonds and stocks will go up, and they balance each other out. Why this is so extraordinary is that this is an interest rate rising and bonds going down, and the stocks went down at the same time. And really what we're talking about, it's a repricing of all asset classes. Real estate is going to have to come down. And so really what we've felt is the air coming out of all this liquidity all at once. And we've really just tried to protect ourselves while it's happening. So the chart that you found, I'll throw it back to you, saying in the quarterly report, is a great chart of just showing just how extraordinary this financial event is.
Yeah, I think the chart was something like in the last, I think it's either 80 or 100 years, but you haven't had interest rates go up like this, hence bonds go down like this, along with stocks to this degree, I think in that 80-year time horizon. So in an investing lifetime, or anyone investing today has not seen this kind of environment before. And I think the other thing too that's noteworthy, it's so interesting thinking to, even where we were a year ago, and some of the rhetoric and sort of positioning that both the central bank in Canada and in the US were saying about inflation and interest rates. And, the idea that even a year ago, rates were going to continue to stay low for long, and, and all of that verbiage. And what really happened this year, to start the year and then into February, March with what was going on with Russia and Ukraine, it's almost like central banks around the world hit the panic button, and collectively we're trying to get off of zero and as fast as possible. It's almost like, a plane for takeoff, and you're pulling up on the throttle, trying to get the plane as high up into the air as possible, because there's this concern that inflation was, persistent and embedded. But at the speed at which interest rates have come up, I think, none of us would have said a year ago it was going to happen. But now that we're here at, say 4%, very short-term interest rates in the US are a little bit higher, but maybe speak to the idea of, how far along this hiking path are we? How much higher can they go from here? And, I guess also the more economic implications of interest rates being at this level with this level of debt that we have globally. How long can this be sustained with interest rates this high?
So if prices, hitting that directly on it, and I just mentioned that there's a couple other great charts that you were then referring to, is that 85% of central banks globally are tightening all at the same time.
Yeah.
We tend to live in our own bubble in the world, but this is a global phenomenon. And in terms of global bond prices going down, this is easily one of the worst years in financial history. And what we're trying to do is have a strategy to get through this as the clock getting reset. And I think coming back to the chart, which is even just notionally saying, if once you've had a really bad year, it tends to be good going forward. And so the way you're phrasing it is saying, how far through the move are we? If inflation, headline inflation is up now, but it's not necessarily the prices are coming down. Prices have gone up, but stay up. but that doesn't mean inflation will accelerate from this point of view. Prices will be high, wages go up, but then they'll sort of stay at the higher level. But then CPI, the actual year-on-year change of CPI, will be down. In which case, if bonds we were going from a very low bond interest rate and we're up to sort of 3.5 in Canada and sort of a little bit higher in the US 4, and maybe if it's somewhere where in the US we would get to 5%, that means that 80% of the move is done. And for ourselves as investors, anytime that 80% of something is done, you're not waiting for the last to hit it'd be great to say, this is the day, this is the low, but you never know. You actually sort of have to start positioning yourself in a much more positive frame. So this is today's conversation. We really want to hit that of sort of saying in the bonds itself at this level, we can actually build a bond portfolio that gives us a decent rate of return for the first time in easily 5 or 6 years that we've been able to do that.
And this also speaks to the topic where, interest rates being as low as they were in many ways creates just as many problems as well for both bond investing. It makes, certain segments of the equity market, extremely overpriced, and it sort of creates its own investing dilemma as it is with interest rates when they're zero or close to zero. It's the process of coming up that has been disruptive so far this year. But I think now that we're closer to being at a level that is more normal, I think both on the bond side and then also on the equity side, I think, it's time to be much more optimistic than it would have been a year ago because the path for interest rates was so uncertain. And I think that's one of the things that we really wanted to highlight in the quarterly letter as it relates to the equity portfolio of just saying, we know the market's down. We know, sentiment is really low. We know that there's concerns about a recession, whether or not we're going to have one next year. But at the same time, the stock market is down now, already reflecting all of that information. And so this has definitely been, the longest, slowest decline that we've had now in, well over a decade. But as an equity investor, it's actually a time to be excited and looking for opportunities because everyone else is now, worried or concerned. And I think, by the middle of this year, it became evident that, there are a lot of opportunities out there on the equity side. And it's just a matter of being patient and waiting, as we go. But maybe speak to that too, that idea of opportunities heading into 2023. I think there's also this topic that maybe you want to highlight of, we're not necessarily sure that the market is at a low or is at a bottom. We could still head lower from here, but at the same time, there are lots of segments of the market that are already really attractive. And that's kind of where we're devoting our attention to.
Yeah. So and when we have the investment meeting and we're trying to pick apart our time horizons, and again, in simple summary, we've already said that, okay, interest rates are at a level we can actually build a bond portfolio. So put that in that category. The stock portfolio, which has always had much more moving parts to it. Bigger picture, longer term, this is always the irony of stock market investing, is if prices are lower, that's much better for us as longer term investors because we're constantly buying, constantly redeploying money, and we get opportunities at long term. Now, the problem is, though, that we have a short term and then we have a medium term before we get to the long term. Yeah. And I think we just touched base on our strategy right now. And again, since we wrote the quarterly report 2 weeks ago, and we had the number of other charts in there sort of showing how oversold the market was, but now how fast things move. I'll just throw it back. In the short term, we've actually had a bit of a move.
Yeah, I think that's the other thing too, is that the short, week to week moves really since the summer have become, violent up and down both ways. And I think the concern too on the equity side through this year was that at some point the expectation was earnings were going to start to really roll over. And then as interest rates have gone up, there's an idea that, well, you should reprice those lower earnings at a lower level. And the question was the market priced properly for where earnings were? And I think what's really interesting about, certain segments of the market, but even throughout this year, there are so many businesses and sectors that have had very resilient earnings. So in light of a slowing economy and slowing demand, you've had a lot of businesses doing record numbers. And it is an indicator of strength in and of itself, in that even in a weak market and in a weak economy, if you're operating your business to a degree that you can actually still be growing your profits, I think that's something to be, highlighted. And then the best part too about interest rates resetting higher here is that valuations across the board now are at much more attractive levels. And so, it was uncomfortable at the end of last year because everything had risen so much. And I think as an equity investor or an investor in general, it's really the only thing I can think of where, when prices go down, people, want to buy less. And when prices are up, people want to buy more. It's the opposite of, shopping on sale. And when prices are down, you want to be excited because you can buy things cheaper. And I think that's kind of where we are right now. But to the sort of more intermediate term, I think the question is, still what path does policy take from here? How high do interest rates go? What level of interest rates can the economy handle? I think, one thing we haven't touched on yet, we looked at it this week in the investment meeting, just with the current levels of debt, both in, let's just say, Canada and the US, there's a certain point at which interest rates at this level will really start to bite. And I think that's something that has not really talked about by the central banks with their speed of rising interest rates, but that's a fact that's going to happen at some point, which probably puts a recession into next year, a very high likelihood. But in many ways, I think, having cash still in the portfolio and being defensively positioned, it puts us in a position to take advantage of that. And the equity market tends to bottom long before the recession is certainly over. And we haven't started it yet, but maybe speak to that too, of just saying past recessions, the market will bottom long before the economy bottoms. And as equity investors, you kind of have to be, ready to go long before, it's obvious that the recession is over.
Right. So maybe trying to give a definition of the different time period. And so when we're thinking about the stocks, it might be different than the way other people think about time. So if we're thinking about long term, here's a business we're looking at. We don't compound unless we own stocks. And when we're looking at a business, we're saying, hey, 5 years from now, is this going to be a great business? Is this going to be a better business? And can it grow from here? Mm-hmm. Even though we have all sorts of challenges. And in previous conversations, we said there's all sorts of things we don't want to buy. But it's amazing how a number of businesses are doing just fine. Mm-hmm. So let's focus on the things that are doing fine and really thinking about this business out in a sort of a 5-year time horizon. Talking about the short term, the bounce that we've just had, these could be 1 week, could be 3 weeks moves. And then an awful lot happens, from taking interest rates, currency moves, and then stock market moves, the oil price, all that. And we really get some strong moves. And again, because there's all sorts of factors. Say there's less liquidity in the market, so prices move more violently. And then where you're saying next is we're trying to say if you have a recession, it's looking out 2 quarters from now. We're going to be talking first quarter, we're going to be talking the second quarter next year. We're thinking about next summer. Mm-hmm. Where are we going to be? And even if we're in recession by next summer, the market might start to be looking through the recession. So that sort of gives a sense of the time horizon. And still the conclusion we come to from the investment meeting is we still want to be conservatively positioned, even though we had this reflexive up move from negativity. We haven't really solved any of the problems yet, the big problems, and the big problems might not be solved for a while, but the stock market starts discounting that they do get resolved. But right now, we just feel like it's just going to take a bit more time and just to be patient. But patient also means we can still capture dividends, compound our stocks, and just make sure we've got lots of flexibility and optionality in the portfolio that's like, boom, you get a move, you can take advantage of it. Yeah. So I'd come back to you just sort of saying, because I think there's a theme always when we're looking at these companies, and you've done a lot of work just absolutely making sure, that the fundamental idea to me is you're not going to rely on the stock market for where your money's going to come from. There's certain businesses that we've really tried to, frame the portfolio around.
Yeah, I think one of the things that, we've really thought about this year in terms of investment selection, say for new things that we've found, is that, our expectation is that, let's just say we're in a prolonged period of uncertainty with regards to the stock market and interest rates. And so essentially in that kind of environment, you want to own companies that don't need financing either in the stock market or by selling bonds, because the financing environment is going to be uncertain. So essentially, if you have companies who don't need any money and who actually are able to generate excess cash flow, a lower share price is actually a great time to be buying back stock, because essentially what happens is for us existing shareholders, once we're through this and things get better, then we proportionately own more shares of a good company. And so I think that's one thing that was really a focus of us. And it also speaks to, the companies I think that are doing the best right now are actually companies that have that characteristic where they're buying back stock. They don't need money from the stock market. They're essential businesses or businesses that, we would define as easy to understand and that have some kind of competitive advantage. But even in a tougher economy, I think these kind of investments sort of stand out. And it's really the ability to, if you can accretively be buying back your stock in a down market, that's the best way to kind of get through this period. It's the companies that needed the stock market to either sell equity or to finance themselves that then in this kind of market, you've kind of hit a wall. And so that's really one thing. And speaking to that kind of characteristic, I find what's interesting is there's been such a focus the last number of years on US tech, US large cap stocks, and such a significant push into indexing that still all anyone can talk about is the Apples of the world, the Microsofts, the Googles, the Facebooks, all those companies. Well, at the same time, there's all of these other businesses that are actually making new highs, essentially, breaking out to new 52-week highs.
Yeah, I think that's a great point. In our portfolio, we've actually got businesses, whether it's in the energy business or in healthcare, they are not in a bear market. They are hitting new highs today, and you just can't get too negative because you don't know where performance is going to come from.
Yeah, and it's almost like the headlines are rightly saying we're in a bear market, but certain segments of the market are already in a new bull market. But they're more obscure. They're not mainstream, being talked about in the financial press every day. And for us as investors, that's great because we think we've come along to, a handful of businesses that other people, don't appreciate yet. And then the better thing is that we're able to actually buy all of these at really reasonable prices too. So it's both a combination of wanting to continue to own those kind of companies, but the fact that they're doing so well relative to a much tougher market, I think that signals, certain strength going forward. And that's something definitely to be optimistic about as it relates to the equity portfolio.
I think I want to hit just that one idea that you touched on, which is, I think, just essential to this, is even if you had just a hypothetically 3 years where it looked like the portfolio on a dollar basis isn't going anywhere. Here's $1 million and $1 million sits at $1 million. And again, depending on the types of businesses you have, but if we have dividends coming in, we're reinvesting dividends, or the company is buying back stock, there's an awful lot of wealth creation that is happening that we know is happening, but you can't necessarily see from the overall portfolio value. But if we're treading water for 3 years, just taking it down to one stock, if you have 100 shares of BCE, 3 years from now, you actually have 120 shares of BCE. And just because the stocks are kind of sliding, but when the market turns around, you actually have an awful lot more stuff. You have an awful lot more value.
Yeah.
And this is, again, why you actually have to keep doing it. And then you come really strongly out the other side because you built value as you've gone through, a slow market.
Yeah, it's sort of silent ways of compounding is that when you own good companies, and if they're buying back their stock or you're buying more shares of them as you're going through this, you come out of it on the other side owning more shares of a good company. And that's kind of the idea where it's almost in that kind of environment where, let's say multi-year muddling along for the overall index, there's lots of things under the hood that can still be reinvesting in their business, buying back shares. And so as investors, if we're paying a reasonable price for those kind of companies, I think it's really exciting, even though the backdrop remains tough and the headlines are tough and it could, continue like that for some time. But I think there's a lot to be optimistic about. And I think that's really one of the core messages too, where our messaging, I would say at the end of last year was far more negative because we were still up at a high on almost every asset class. And now that we're, 10, 11 months later, at much more attractive levels, I think from our perspective, we're far more optimistic than we've been in a long time. But I can understand why for people reading the news or watching financial TV, it doesn't feel like that. So that's kind of one of the main messages that we would put out there. So why don't we wrap it up on that, and then we'll get this out, and we'll look forward to the next quarterly podcast in a couple.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.